Hello, my name is Daniel, and today I'm going to look into flow traders. This was actually on a request by one of my copiers on Ether, who asked me what my favorite financial company was, and okay, it's already quite clear it's flow traders. I don't actually own it on Ether, I do own it on another brokerage account, and I wanted to talk about why I find this company interesting. Is it what do they actually do? Because it's a bit of a more complicated company to analyze in comparison to other companies in the market, especially as this is some fintech market makers. People might know them, and that might seem vague. I'm gonna elaborate on that further, what they actually do, find out are there underlying trends, is fundamentally, is it actually growing, or what is happening at this company? Is it worth what it's trading at? And some other interesting things in relation to this company. You can follow me on Ether, find me at Tipsno. On Trading 212 community forums, I'm there as well, and here on YouTube. So if you want to ask me any questions, those are the three places you can ask them. So let's just start. Today, no webcam. Wanted to try it with different equipment, so now a different microphone and different audio might be different, but no webcam on desktop. So let's continue. What does Flow Traders actually do? Flow Traders is a fintech company based in Amsterdam, and they, in essence, they buy and sell correlated assets and make money from arbitrage from that. That they call it providing liquidity. They can guarantee that if there's trading is happening, or if someone wants to trade it through these methods, they can always guarantee fair prices and liquidity, as they're always buying and selling securities or assets, whatever it's trading, they're trading in. And they make money from the spreads basically, and some other things as well. But for this example here, what they stated, the spread is difference between buying and the price you can buy and sell an asset. They are providing liquidity that you can actually buy and sell it, and they make money from the spread. And they call that it's some kind of arbitrage, as they don't really run any directional risk, or at least they're trying not to. That's the whole business model, to provide liquidity so that people can trade. With those trades, a very small price difference can be arbitraged, and that's their profit after they paid their own fees and interest and company expenses and whatnot. They do this for exchange traded products, so that's ETFs, ETNs, ETCs. ETFs are exchange traded funds, you might know them. ETNs are exchange traded notes, it's a bit of more different product, and ETCs are exchange traded commodities. That won't go into depth with those. I'll look into ETFs a bit further, as that's one of the main parts of flow traders, ETPs that they provide liquidity in, at least. They do some forex as well. Nowadays they also start with crypto commodities, and they're expanding into fixed income as well. They actually provide 60%, for 60% of all ETPs, they're the main liquidity provider or an authorized participant for ETFs or other products structured like that. They have quite some market share worldwide. There are some other companies in the space as well, but Flow Traders has quite some market share worldwide. So, okay, how does this actually work? Like these price differences. Okay, when I have this is an example for an ETF. You could apply this to other ETPs as well if they're similarly structured. Flow traders can be appointed as an authorized participant. The authorized participant is authorized to directly communicate with the creator of the ETF, in this case, to create new ETF units. So they look at the differences between the underlying asset in the ETF and what the ETF unit itself is trading at. If it's trading at a premium, then you get a creation process. If it's trading at a discount, so if the ETF value is actually less than what the underlying assets are worth that the ETF is holding, then you can get your redemption mechanism. They are essentially the same but inverted. That's yeah. If you look at the text, you'll see that as well. But in essence, let's go through the creation. If I have an ETF, it holds shares, and those shares are worth, for example, $10. But my ETF unit, it's actually worth $11. Yeah, then you have a problem, because if I buy the ETF, I bought less assets than if I would have bought it directly on the market, and the ETF just holds assets. It's just a holding company, basically, or maybe not company, but structure. So that should not happen. Well, an authorized participant prevents that from happening, because if they see that the ETF is trading at 11 while the underlying assets are trading at 10, well, then they buy the underlying assets, sell some ETF units, thereby bringing down the price of the ETF unit from 11 to like 11.5, 10.5, for example. By buying the underlying asset, they bring the price from the underlying asset up, and in that way, if you do that enough, you'll get a tight spread again, and your difference in your ETF price and the underlying price will basically be zero or close to zero. And that's how they provide liquidity for actually fair prices for ETFs as more trading happens. And even if you execute a big trade with an ETF, which might be even larger than like the total assets under management, for example, if the underlying asset is liquid, the authorized participant will make sure that you'll actually get a fair price. So that's in essence what they do for the ETFs. Like they had some ETNs, ETCs, Forex, and whatever, but that is not that large yet, although they are expanding in it. But ETPs is their main part. Like Flow Traders is a global company. It's a multinational. They operate multiple offices. Their main offices are like New York, Amsterdam, London, and Singapore. Clutch is the office for IT related stuff. They don't actually trade there, as you might see that all the others are located near exchanges, Hong Kong or Paris, Milan, the Italian stock, Amsterdam, London, New York. All those are close to exchanges, but in Clutch they are not, and that's because it's the IT office of Flow Traders. As it's a fintech company, they need really fast IT systems to be the fastest and cheapest in comparison to other market makers. You can see here the numbers of listings that they have. It's a bit misleading, as not every listing has the same volumes and assets under management, but numbers of ETPs wise, they're quite big in Europe and US. Asia is a bit secondary. And in the US, they also have quite some competition from other companies like Fear2 Financial, for example, which isn't on eToro, by the way, but it's you can get it on other brokers. And you can see that they're making quite some money, like trading quite some ETP. Like this company is worth about a couple billion euros, and they're trading quite large volumes. Although they're making tiny margins on each transaction. That's where the net trading income, that's the NT, that's their you can compare to operating income, as this company doesn't really declare revenues and stuff like that on their financial statement, because it's a bit misleading, as it's a bit of a complicated company financial wise. So NT is their measure for operating income. And you can see Europe, at least this was from the last half, for the first half of 2021. Next, or Q3 is like coming in a couple of weeks, if I remember correctly, somewhere near the end of October. So should update everything after that again. But for now, you can see that Europe and the US are their main areas, and the US has been a bit troubled as they had increasing competition there. But okay, how is this underlyingly actually going for flow traders? They're growing their ETP listings, and the ETP market globally is growing quite a lot as well. This is from Statista, that's a German statistics bureau or company. It's a private company as far as I know, and they measured and got data from BlackRock, so it's iShares and stuff like that from all the ETPs that they have. And I think this also includes other providers, but you can clearly see the ETP market has been growing. That ETP, so you should think about ETFs and stuff like that. They're gaining traction in comparison to mutual funds, which are less transparent and have more restrictions and in general are more expensive for investors. Well, these new ETFs and other ETPs provide clearer, more transparent, and just cheaper products than the mutual funds. So that's why this has been growing so much, almost exponentially if you would continue this. It has in 2020 it has stayed fairly flat, but in 2021 the total assets under management have grown quite a lot as well. From in ETPs wise, I do think this is only BlackRock, but if I look at the numbers, but we can see that it's been consistently growing. We expect it to grow, continue to grow at a decent rate, and that should yeah, you can see that it makes some jumps, it stays around. If the market normalizes more, it will not make it will be more continuous. So we'll have to see. So okay, this is the more complicated part. So let me warn you. The VIX, that's the volatility index. It's based from implied volatility from U.S. options. And people like to throw this around everywhere as it's some magic complicated metric, but in essence, it's just measures the expected volatility or implied volatility from options. It's an index, so you can't directly buy this or anything, but although some ETPs do provide exposure to the VIX, but let's not get too deep into that. The VIX, you can see it as a volatility measure. And flow traders, if you have heard about this company before today, you'll probably have heard about it together with the VIX, because the VIX, once the VIX is high, this means that volatility is high. So for example, 2020 or 2008, 2000, during the tech bubble of dot-com bubble, every time something happens on financial markets, volatility is high. 2021 also has had quite high volatility historically, or in comparison with historic terms. And 2020 was a bit of an exception with our COVID crash, the 35% decline in S&P. That was some volatility around that time. But flow traders actually, it's a company that actually performs better during these periods. It's quite of a direct hedge against market volatility, as they do state they are not directional in their trades, and technically they are not. But overall, their business spreads increase when volatility increases in general, and volumes are bigger when people trade more when volatility is higher, or expected volatility. And that just leads to higher volumes and higher margins. So good positive feedback cycle whenever the financial markets experience some trouble. That's why people like to have this company as a hedge in their portfolio. That would have worked out really good last year for people who did that, as this company, they perform better during market crashes, direct market crashes. It's not like gold that if markets crash, it's not necessarily that gold will go up. Gold is more tied to inflation as well, but this is a direct hedge against volatility on markets, financial markets globally. So that's one point why I like this company as well, especially as they basically always make money, as they don't, yeah, only with very low volatility and volumes, but volumes are continuously growing and volatility will just goes up and down. It's difficult to predict volatility, but volume-wise, as we could see with the global market they're in, it's growing. So that's why I extrapolated some points of the net trading income, so basically their operating income, and the fix that was observed in that year. And I took from 2015 to 2020. 2021 isn't over yet, so I excluded it from here, but 2021, if I extrapolated the data, it would be somewhere around here above the line. And above the trend line that's calculated here, at least the trend line would be different if I included that data point. But you can see there's a very positive correlation between the VIX and net trading income for flow traders. This also goes for free cash flow from the company. It's a bit more over the place, but in general, it also increases quite a bit when the VIX increases. And the average VIX over from 2015 to 2020 has been about 15, now 17, I mean, sorry, 17. So you could expect the free cash flow to be around this point, somewhere around here, or net trading income to a similar point. Although that's an average, you can have some years above it, like 2020, or years under it, like 2017, which we can look at here. Here we have some. I could just take the income statement. They don't provide an income statement, but I could take an income statement from some screener like Yahoo Finance or Coifin or whatever. But revenues and that stuff isn't that it isn't that indicative of underlying performance for this company. So I took net trading income, operating cash flow, capital expenditure, and the fixed free cash flow that follows from that. And net trading income, you can see it's been up and down, mostly down over the years until 2020. Then it exploded. 2021, I only have data for the first half of the year, but I multiplied the first half of the year times 1.5 and multiplied capex by 2. Operating cash flow was also 1.5 to get a conservative look on the year. It could very well be that this free cash flow might be higher, but that depends. I don't expect it to be that high, as it is exceptionally high in this calculation. We might see quite a bit larger capex this year, but it's to be seen there. It's we'll have to see, as the first half year of 2021 has seen some volatility. 2020 was an exceptional year in that regard. I don't expect anything like that anytime soon, but that would be, for flow traders, that would be a great year again. But I expect it to normalize around the average, or at least that's what I calculate with, as I find it impossible to predict volatility. That is basically trying to predict market crashes. So I would strain away from that, as that's basically impossible. So I take the average VIX that we have observed over the last 5 years, extrapolate using like this data from here and here, the expected net trading income and free cash flows that follow from that, and then grow it at a relatively conservative rate, and then grow it into perpetuity at an even lower rate. So that's where these numbers come from. The share price that's set as close of Friday 15th, and the shares and market cap follow from that. Using this, we can actually calculate an IRR, or internal rate of return, or net present values at different discount rates. Discount rate is R here. And if we do that using the numbers provided, 3% growth in perpetuity, and 8% among these years, then we get to these present values for those cash flows. And discounting them at different rates, we can see that our internal rate of return is 9%, or approximately 9%. So it's not unattractive, but at its current price of 35, I would find it to be a bit too expensive for my taste. It does this. These calculations don't include any years like 2020. It could very well be that 2024, 2025, or whichever year, there might be another market crash and this company would do great again. But in the meantime, I don't expect them to make a lot of money. They do fine during very low volatility years, but you can see they're not making that much money in those years, not much trading income in those low volatility years like 2017 or 2018. Although 2018 during the end showed a bit more, like December had a bit more action in that regard, but it's to be seen. The market does expect more volatility going forward. I would say it will trend back towards the average until it hits that, or the price of flow traders gets closer to a normal price, because it's quite trading at. It always has been trading at a discount during these years, as people expect volatility to be the same as it's currently been forever. It's gonna change up and down. 2019, people thought it would stay forever around 12, 14. Yeah, then we got 2020, and we had a fix of almost 90 at some point, which you can really see in their income. I would expect it to normalize, and there might be a couple years that it goes higher, but I'm not counting on that. It might very well be 4 years or 5 years again of relatively low volatility. So in that regard, I excluded any high years from my estimates. And 9%, it's decent, but it's too little for me. I would like a 12% IRR or higher, or at a higher discount rate. So that's why I don't have it in my eToro. I already bought it quite a while ago in my Trading 212 account. I've actually been considering selling it, as it has been trading a bit at a premium. This is a company with a negative beta, so it's actually provides less volatility in your portfolio overall. That's also one point why I like it. And during longer crashes, you get your money at like the bottom of the crash, as when the crash happens, they make a lot of money, and then they'll pay that out to you in the form of dividends. This company paid quite some large dividends last year. Those were good times for them. Almost 12% yield all of a sudden. But this company, you could buy it as a hedge. You could buy it as a longer term investment. I'm not buying it as a hedge. Want to buy stuff for a longer term. So I would wait for this company to trade at a more reasonable valuation. And I do have to give it the benefit of the doubt with future cash flows, as these are estimates. Based on these estimates, I come to this conclusion. These estimates could be wrong. We don't know the volatility in the next couple years. I don't. Nobody does. If you knew, you would become very rich. So, based on all these data and everything I know from this company, I would expect this return from it, which is under historical market returns. So I'm not buying it or adding to it. Here we have the fix. Here you can see what happened. It's a bit cut off, as this is a longer term graph, but you can see that historically the fix isn't that high, except for a couple times when something happens in the market. Here you have your trade war with China, from between the US and China. Here you have 2020. Here was some other volatility stuff happening. Yeah, we have seen elevated volatility, but it is already trending back to normal levels, and I can expect that to continue. So I'm not buying it at these prices. Okay. If you have any more questions, feel free to ask them in the comments below, and you can follow me on eToro. My link is in the description. And I hope you have a fine day and found this analysis, albeit a bit simplified, interesting. Have a nice day.